Good morning or afternoon, depending when you're watching. Today is January 6th, Friday, and mortgage prices are 3 basis points better compared to yesterday's close. Stock market futures were flat, and everyone was kind of focused on the jobs report that came out for December, so that was released. We'll go into that a little bit more after. The Treasury 10-year was down. It was trading at 3.73%. It closed yesterday, I believe, at 3.74, so it's barely down anything. And the big news was that the U.S. added 223,000 non-farm jobs in December. So there's more jobs in December. Not only that, unemployment rate fell to 3.5%. So there are less people unemployed based on the statistics and the numbers. Not everybody trusts those numbers, but that doesn't matter for this conversation. We're trying to figure out what's going to happen with the markets, real estate market, mortgage market, etc. So both of these numbers came in higher than what was expected, which means that most likely we can expect the interest rates to stay high and possibly go even higher. The Fed already said they were going to continue to raise rates. Unless we get unemployment up, the Fed doesn't really have any motivation or reason to pivot. So if unemployment goes up and more people start claiming unemployment, then we may see that pivot where interest rates will then go down because they're trying to stimulate the economy. So what does that mean? Well, again, all of this depends on your specific situation. So if you're looking to buy, you can still buy. We're having success with asking for seller credits, negotiating seller credits to get buy downs done, which means you buy down your interest rate. So for example, if it's at 6.5, 6.75, buy it down to like 6.25, 6%. And then later, mid-year, the end of this year, possibly until next year, once rates go down again, then you just refinance, get that lower rate. And now not only did you buy the house at a discount, because we are seeing heavier discounts on houses, you also are able to refinance later. Now on the other side, what about sellers? Well, sellers, there's still plenty of homes being sold. As long as the property is marketed correctly, and go into my page, there should be a new post about 3 tips of how to market the property correctly, then you're fine. The issue is when they're not marketed correctly and they're just sitting there, that's when you got to figure out what you want to do. So if it's marketed correctly, it's going to sell. There's plenty of buyers in the market. I have plenty of buyers that we're working with, so I know there's buyers out there. The other thing you can consider is leasing it. If you're like, you know what, I'm not going to get the price I want, I'm not comfortable with that, lease it. There's plenty of people looking for renters. Yes, there are some risks there. Yes, let's have a conversation so I can go over different things you can do to mitigate those risks. But leasing is definitely a good option. That is a way to not sell it right now. You're not getting the price you want. Eventually, 10 years, 15, 20, 30 years, whatever, prices will go up. So that's another option. Or what some people are considering doing is just cutting their losses, getting rid of it, getting into cash right now because they're expecting a major drop to continue to happen. Right now, we just started coming down on prices because, obviously we hit the peak and then interest rates went up and then prices started going down. Why? Most buyers buy based off of monthly payments. So a year ago, when let's say the house was 650,000, 700,000, that monthly payment is the same as a house today at 550, 575. So the monthly payment is really what's going to dictate how high those prices go or how low they go. So yeah, some people fire sale, get me into cash because they're going to go lower and they want to buy more investment properties. So that being said, have a great day. I think I say that being said too much, so I'll work on that. Take care. Bye.